All right, it is Thursday. Welcome to our weekly State of the Market, brought to you by Phenom Group. My name is Seth Golden. As usual, I am your host. A little bit of surprise, possibly next week we might have a co-host. So that's something different and something to look forward to. But again, welcome to this week's State of the Market. If it's Thursday, as I've said here, pretty much every weekly State of the Market, unfortunately, the markets are usually red. So let's go to the tape. We've got a completely different Thursday shaping up here, folks. Have we made or have we successfully retested the lows back from March 15th and February time period? It's very possible. Now, remember, we have been highlighting our outlook on our weekly State of the Market videos and within our weekly research reports at Phenom Group. And if you don't receive our weekly research report, subscribe today to phenomgroup.com. Make sure you get that. It comes out every Sunday. With that being said, our outlook has been the lows of the year, 4114 on the S&P 500 to 4600. So far, we've made that round trip once. We've come back down. Now, on a closing basis, the S&P 500 closing basis lows for the year, 4170. And then it did it again at 4173. And then just yesterday, 4175. After getting to that 4600 level I had just mentioned. Here's your S&P 500 today, up 104 points. Again, so it's tagged this 4170s level 3 times this year and has since bounced. Now, it's all fine, well, and good when we're trading at the upper end of that trading range I just mentioned, 4114 to 4600. But when we get back down to the lower 4100s, as we have been this week with an early week sell-off, people all of a sudden think everything's gone awry. The bearish sentiment starts to beat that drum again, and investors lose all confidence whatsoever. But the reality is, it's just been a broad trading range. Nothing has happened except a derating of the S&P 500 multiple coming into this year. Coming into the year, we were trading at a 21 times forward PE multiple for the S&P 500. Folks, we are below 19. Earnings are still going higher. We're in the midst of the peak of earnings season right now with big tech, large cap growth stocks, FanMag, all reporting here this week. And for the most part, surprising to the upside. And so the earnings estimates have been ratcheting higher throughout this earnings season, but the market's been coming back down to the lower end of the trading range. Price, as part of the PE multiple, the P in price has been coming back down to the low end of the trading range, although the E is going up. And that's a byproduct of interest rates rising, expected to rise further as the Fed will be hiking rates. And so our equity risk premium has been moving to the downside, and the S&P 500 along with it. This is just a mid-cycle transition, if you will, a mid-cycle re-rating, so to speak, getting all the crap that is unprofitable out of the way, and all the high PE multiples and individual names, getting those disposed of, and you're left with the cream of the crop. And you can say that about investors too. A lot of investors getting shaken out here. A lot of new traders since the pandemic. They're getting shaken out of the market as well. Your experience, your disciplines will serve you well if you stick to them in this environment. All right, so let's get into it. Weekly State of the Market, the highs and the lows. That's our trading range, folks. So are we going into a bear market? Well, quite frankly, it appears difficult to do so on the S&P 500 and Dow. We know we've gone into a bear market with the NASDAQ. That's where all those high PE, unprofitable tech companies reside. Remember, the NASDAQ Composite Index is 4,700 stocks. It's not the S&P 500, folks. All right, so as you can see here, bear markets start one of two ways, and we don't think either cause is present currently. So we don't think that the current conditions warrant bear market. We call bear markets start in one of two ways, and we don't think either cause is present currently. We call them wall and the wallop. The wall refers to the proverbial wall of worry bull markets climb. As Sir John Templeton described famously, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. In our view at Phenom Group, it appears pretty clear we are far from euphoria. A wallop is when a multi-trillion-dollar negative, okay, a multi-trillion-dollar negative like a worldwide pandemic, lockdowns, wipes out global economic growth unexpectedly. That's your black swan. Widely watched fears circulating in the news may be grounded in reality, but they don't qualify as wallops. They're not going to wipe out, multi-trillion-dollar economic growth. The lack, the scale, although we are monitoring all of these macroeconomic conditions equally, we don't see them snowballing. And enough surprise power, however, if you get enough of these worries coagulating, if you will, or coalescing together, then you could have a problem. That's why we continue to monitor the macro fundamentals on a daily basis. But right now, we don't see, either of the bear market scenarios, the wall or the wallop. It can change. We know markets move fast. We know that we are in unique, unprecedented circumstances post the pandemic. So we need to monitor everything closely. All right, this headline here from Bloomberg. George Soros, famous investor. Soros says China hard landing will deepen the rout in stocks. Billionaire investor says he shorted the S&P 500. He's betting against Asian currencies and he's buying treasuries. The headline above looks frightening, doesn't it? And you got Nouriel Roubini's comments in here as well. Billionaire investor George Soros said China's economy is headed for a hard landing that will worsen global deflationary pressures, drag down stocks, and boost U.S. government bonds. A hard landing is practically unavoidable, he said in an interview with Bloomberg Television. China may move from these lockdowns in Shanghai to lockdowns in Beijing. We know that. We've been hearing that for the last 2 weeks, right? China's no COVID policy. They've locked down one of the largest provinces in China. It may move on to Beijing next. I mean, that will definitely dent global growth. We know that. Oddly enough, though, you still have crude oil above $100 in this circumstance. But here's the point. This looks very fearful, right? And this is what we're seeing in the headlines right now. Here's the problem. Look at the date. January 21st, 2016. So the same things that we're hearing about China today, we've heard about China before. The circumstances are different. We recognize that. The media doesn't. They're going to play up the same angle all the time. It's a fearful narrative. It's a cautionary tale. It's a warning sign left, right, front, and center. Did China have a hard landing back in 2016? Did the U.S. economy have some kind of great impact where we went into a recession? S&P 500 was up in 2016. In fact, it had corrected from late 2015 to early 2016, and I think in March of 2016 it rebounded and was up and to the right the rest of the year. So be careful with headlines, folks. This is what the media does. It's their job. They deal with hyperbole, or they deal in hyperbole. So I've had a lot of conversations with a lot of investors this week, and people are feeling, as we are trading at the lower end of this range here, year to date, there's a lot of anxiety. There's a lot of folks that are leaping to conclusions that, can prove detrimental to their portfolio performance. So if the market feels like it did in late 2015 to early 2016, that is likely because certain segments of the market have been performing as they did back then. This is the NYSE FANG index here, folks. By year, this is the individual years. Here we are in 2022, right? That's your Teslas, that's your Facebooks, your Amazon, your Googles, your Netflix, your Nvidias, all these Microsoft, all these different stocks are in the NYSE FANG Plus index, if you will. And look at their performance year to date here, right? Here it was back in early 2016. So I get it. There are sectors of the market which are heavily weighted, whether or not they're in the NASDAQ or the S&P 500, that continue to push the markets lower. But the month's not over. Keep that in mind. April is thus far the worst month ever for the most popular growth FANG-like names relative to the S&P 500. This is a relative performance ratio, FANG versus the S&P 500 index. And it's performed, this is the worst month ever in the index's history. But again, the month is not over. We have we've got a really good rally going on here, folks, and we seem to be holding these gains at the moment. It's a long year, let alone we've got a couple more days here in the month. And here's a look also. Here's the NYSE FANG Plus index relative to the SPDR. This goes back to, 2019. So we're going all the way back to a 3-year chart here. You saw a fantastic outperformance. When the trend line is going up, that means NYSE FANG is outperforming the S&P 500 index ETF, or the SPDR as it's known. So the trend line was going up, and throughout 2020, here starts 2020, just kept going up until here's 2021, hit a peak here. And ever since then, NYSE FANG has underperformed the SPDR, the S&P 500 index ETF. But we draw our potential support line, because we're basically back to this level right here, which basically wipes out the 2020 performance. I mean, if you think about markets being asymmetric or reverting to the mean, that's probably part of what's going on here in 2022 as well. We're simply getting some reversion to the mean, all of this outperformance. I mean, healthy outperformance too, folks. I mean, that is a steep climb in NYSE FANG relative to the S&P 500. So it's very possible that once we hit this support, if we hit this support, we bounce off of this level and begin a new uptrend. No guarantees. Anything we look at in the way of technicals, market technicals, is just a developing story. It doesn't predict the future. We continue to monitor it, but I think there's a good thesis there that suggests we could find support here. And lo and behold, when would it be happening? During earnings season. Now, if Apple, if they don't get good response from their earnings reports, which come out after today, then we may not find support here. We may break through, and then we have to recognize that the environment is different and probably will be different for some time to come. Another reason why investors are frustrated, this is a frustrating year. We're range bound, right? I mean, there's no true trend other than, the fact that we are down year to date. We haven't broken down, but, until we break out and stay above 4,600, we're just in a very broad trading range, which can be, frustrating for investors. The other aspect, when we look at this chart right here, the S&P 500 is suffering prolonged declines not seen in decades. Well, what do we mean? What is, what kind of numbers? What are the parameters around this prolonged verbiage here? So this is from an article in Bloomberg also. Trying to pick the bottom in stocks every time they fall is proving costlier this year than at any time since the 1970s. In short, the bullish impulse is being wrung out. In 2022, the average drop in the S&P 500 has lasted roughly 2.5 days, more than any year since 1974. You have to go back here to see that the top line is number of days, and this is the percentage drop. Top line, yeah, you have to go all the way back, 1974. The drops in the market are lasting 2.5 days, at least, on average. And the down sessions have been negative 0.2%. Yeah, there you go, 0.2%. Did that here in the 85-89 period, and then back before 1975 to 79 period. So again, if it feels like it's a painful year, the price action is in the fact that the dip buyers just aren't there. This has been a different regime. Last year, if you bought every dip, you got quickly rewarded for doing so. This year, if you're buying every dip, you're not rewarded very quickly at all. How do we know that the dip buyers aren't here? You can do Google searches. Type into the Google Trends search engine, buy stocks. Back in 2020, big time. People were searching. They were interested. Here in 2021, January 2021, same thing. We had dip buyers galore. But look at the search volumes now. They're back to basically 2019 levels. What does this tell me? This tells me that we have indeed lost a goodly portion of participation in the market this year. 80% of new traders that started here in 2020, maybe even 2021, but 80% of new traders will be removed from the markets within the first 2 years of trading per a New York University study that goes all the way back to 1992. And based on Google search trends, it looks like that's been happening here. Looks like it. All right, so a lot of our quantitative data just hasn't been panning out this year. And a lot of it we've been looking at short duration. So what we've seen lately in these kind of washout days, how do we know that we're having washout days? Volume. Volume is telling us that. Most of the volume has been to the downside. And you say, well, shouldn't we expect that since the market's been getting? Not exactly. A lot of times we can go down on relatively muted down volume. But that hasn't been the case lately. When you do get a certain percentage of down volume on a given trading day while the market's down, it can signal, that you're either oversold, you're getting oversold, or you are completely washed out. And that is what we have seen recently and what this study identifies. The NASDAQ had a 99% down volume day on Tuesday. Right? Tuesday, the NASDAQ was down more than 3%. 99% of the volume was downside volume. The study above is a back test of events of 99% down volume over the last 10 years, and it has very promising results. We're looking at 63-day returns. So why 63 days? Because that's essentially 3 months. 3 months of trading days. And after you've had a 99% down day, over the last 10 years, the average return was 9.74% for the NASDAQ 100. The positivity rate because that's the, one of the key factors that we look at. It might have gotten, a big year return here or a big return there, and maybe a real bad return on another particular occurrence. So that's why we want to look at, the whole numbers of occurrence. And this has happened 25 times over a 10-year period. The positivity rate right there, 88% of the time. The market was, or the NASDAQ 100 was up after we've had a 99% down volume day 3 months later. 88% of the time, you had positive returns. Maybe you don't get the average. Maybe you get below average. That's why we look at the positivity rate. That tells us at least we should be higher. Well, how much higher remains to be seen, but that's the average right there. All right. Coming into yesterday's trading session, unfortunately, the NASDAQ was down 12.16%, 12.16%, with just 3 days left, 3 trading days left. Yesterday, the NASDAQ was down 1 point. Today, we've got a big move in the NASDAQ, right? And we're actually hitting new highs on the day here. So what this chart tells us is that the last 3 trading days, when you've been down 10% or greater in any given month, going back to 2002, at least being 10% down, going all the way back to 2002, with just 3 trading days left in the month, only one time, and it was 2002, only one time was the NASDAQ negative over those final 3 trading days. Every other occurrence, positive, 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 positive. And we'll see what happens here. So far, if we close where we close, we got a substantial gain. We don't know what Amazon or Apple are going to report, but so far, it's looking good. Here's the other thing that we've talked about in the past, and speaking of FanMag or the tech sector, right? Microsoft had a fantastic report yesterday. And that is the second most heavily weighted stock in the technology sector, ticker symbol XLK. We've talked about how the insiders are buying up their stock. Right? We've talked about this in the past weeks, in recent past weekly state of the markets. So here's the other thing that you need to recognize. Not only are they buying tech, which is, also the heaviest weighted sector in the NASDAQ 100. But insiders, corporate insiders, are also buying the NASDAQ 100. Look, they're buying tech, they're buying the NASDAQ 100. Like, what do these corporate insiders know that we don't? Unless they're simply doing it because they're getting a value. The NASDAQ 100 and the NASDAQ composite at their lows are down some 23%. They're getting the deal. They were doing the same thing in 2020 during the pandemic. When the buy rate is this high 3 months later, look at the positivity rate. Look at the average return. Looks pretty good, folks. 6 months later, 98% of the time when you've been at this level of insider buys on the NASDAQ 100, 98% of the time positive 6 months later. Every single time the NASDAQ was higher a year later. There's no guarantees, but come on. This would have to be the outlier, right? And I'm not saying it can't be, but the insiders are buying. And they've never been wrong a year later. They've never not made a profit. All right, so we talked about NASDAQ and down volume. This study here, similar. Percentage of volume declining on the S&P 500 was also just above 90%. And it happened 2 out of 3 trading days, from Friday of last week to Tuesday of this week. 2 out of the 3 trading days, the S&P 500 down volume was greater than 90%. The average, this is just looking at 10 days later. So after this signal fires, 10 days later, the market return was down another 1.9%. This is not what we want to see. But we're trying to be objective here. Again, this is just 10 days, 2 trading weeks, 2 trading weeks. S&P 500 down volume 90% or greater, 2 out of 3 days. It's a very narrow window, and we're only going back to 2013. Let's see if we can find something more. This one goes back to 2001. We're using the same data. What happens 2 of the past 3 trading days had more than 92% of the volume in the S&P 500 coming from declining issues. There were 24 occurrences going back to 2001. A month later, so that's 4 weeks, 4 trading weeks. Month later, the average return 1.9%. 2 months, 3 months, 6 months. A year later, look at the positivity rate. 6 months later and a year later. This is why people buy the dip. Because they know this environment generally just doesn't have a long life cycle. You're investing capital. Most investors are investing for a return on capital. That's one of the fundamental reasons the market goes up over time. All right, week, first 4 months, week, year. So if we don't get our act together here soon, folks, the market is going to be down 3 of the first 4 months of the year. We need something like a 7% rally this week to get out of negative territory. And we only have a couple trading days left to do it. It's pretty unlikely. So looking at years where 3 out of the first 4 months of the year, the market was down, it's done this 11 other times since 1960. 7 of the 11 years that started with 3 out of the 4 down months also turned out to be down years. The chart compares the average annual return for these 11 years to the average return for all years. So in these years, the average return was down 6%. S&P 500 is down more than 6% right now. Hence, we could still be higher over the next month, 2 months, 3 months, 6 months. By the end of the year, we could still be higher than where we are today and still yet fall, maybe 6% for the year, which is what happened in 2018. S&P 500 down 6% in 2018. But this is, again, trying to put things into their appropriate perspective. This is why we use historical data. It gives us the appropriate expectations. Should we be thinking about S&P 500, 5,000, 5,100, 5,200? Not based on this data. Not based on this data. It's not saying it's not possible, but we deal in probabilities as investors. The better our probabilities, that's what we want to lean into with our investing capital. All right, so far this is the worst month of April for the S&P 500, going back to 1970. Right there, down just about 7% here this year. We were down 9% in 1970. A bad start to April, though. Now, we've already looked at the NASDAQ, and the final 3 trading days are usually positive. This is looking at the S&P 500 final 3 trading days when the S&P 500 has been down 7% or more, as it is, with 3 trading days left to go in the month of April. Generally, the final 3 trading days, just like with the NASDAQ, and this goes back to 2007, have been positive. Generally positive. Average return 2.8%, up 91% of the time. This year, I've heard every excuse in the book so far as why this year is so bad, why it's going to get worse, and the Fed this, the economy slowing that, blah, blah, blah. Look, folks, it's a midterm year. The average midterm year decline is 17.1%. At our trough level, we were down about 14% in the S&P 500. Right now, this is, pretty much par for the course during a midterm election year. And maybe it does get worse. This is one of the reasons why I've said I don't think we made the low for the year. One of the reasons. We may have made the low for the first half of the year. But a midterm year, the average decline is 17%. You have to lead. We may not get the average decline. Maybe we've already bottomed and we'll just be in this range for a goodly portion of this year. Maybe we get the fourth quarter rally that we've also talked about in the past. But right now, you can make any excuse you want in the world, but it's living up to the midterm year. In midterm years, they don't typically bottom on average until August. We've talked about this before as well. And why am I reviewing it? Why am I reiterating these things that we've talked about before? Because we've got to keep an emotional quotient that is steady in order to do our jobs as active portfolio managers. When we look at the black and white data, it removes the emotion and it tells us this is normal and to be expected. Why am I so, overly excited about, where the markets are at this point in the year, in the midterm election year? Carter Worth, you may have seen him on CNBC many times, and this would actually fulfill that 17% drawdown in a midterm election year. There's a gap open in the S&P 500. What is a gap? Well, sometimes, when the market opens, we're up 1% right out of the gates, or we're down 1% right out. It doesn't have to be a perfect 1%. It could be a nice half, 3/4%. Those are what we call gap opens, either to the downside or to the upside. Now, we still have an unfilled gap going back to 2020. This gap down here at 40.20 remains open. Now, rule of thumb, when it comes to gaps, more than 80% of gaps get filled. Not all gaps get filled, and it's a rule of thumb for the indexes, not individual stocks. So there is the possibility that this gap could get filled, and we're only talking about this, right, because we're trading at the lower end of the trading range. That's why it was recently highlighted by Carter Braxton Worth of Worth Charting. Had we not been trading this low, you wouldn't even have heard of this. But it's a good thing. We know we have, we can put it into our, expectations bank, if you will, and realize if it does get filled, that's a market operation that we can check off our list. It's over with. It's done. That gap got filled. We can move on. Usually when these gaps get filled, the market has this memory. It has this symmetry to it. It likes to revisit the scene of the crime, so to speak, different levels lower and then different levels higher. All right, this is a chart that we frequented so far as risk on versus risk off appetite. And, and thinking of the chart that we showed earlier, the NYSE FANG versus the S&P 500 index ETF, this is a similar chart that says, maybe the risk on appetite or the risk off appetite is ending at this possible support level. Here we peaked coming out of the pandemic, right? This is 2020. Here we are. This is the relative performance ratio, equal weighted, of consumer discretionary, which is risk on, versus consumer staples, which are risk off. So when the trend line is rising, it's because consumer discretionary is outpacing consumer staples. And we like that. That's risk on. But ever since November of 2021, we've had more of a risk off environment. And maybe this comes down, tags this support line, which goes back to this former resistance level, some consolidation, and then lift off again. So maybe we come down here, tag the support level, because we also tagged it right here once, and maybe we lift off. Well, guess what is a consumer discretionary stock that is reporting after the bell today? Amazon. Amazon's going to have a lot to say with respect to how this relative performance ratio plays out going forward. Inflation is obviously a hot topic. That's another reason why folks are so bearish, because, well, where you have the hottest inflation levels that we've seen since the 1980s, we know that the Fed gets involved. We know the Fed is on a rate tightening or a rate hiking regime this year. And what we also know, based on this study right here, from 1945 to present, basically, when inflation decelerates or is unchanged, the S&P 500 is largely positive. Unfortunately, when inflation is accelerating, most of the candlesticks are down here. It's okay if it's accelerating from a 2% CPI to less than 4%. That's okay. This is why you still have positive gains. But when you start to get to 4% to just under 6% inflation, or CPI, consumer price index, market doesn't like it so much. 6% to just under 8%, market doesn't like it so much. Greater than 8%, market really doesn't like it. And we're just above 8% presently. So what we are looking for is deceleration. We want to go from less than 8%. We want to get under this. We have less. But this would be deceleration. Inflation decelerates from 8% to under 8% here. We're looking at strong returns in that environment. So that's the objective going forward, is to see the CPI, the consumer price index, peak, roll over, and the markets will like that. As I've been saying this week in the Phenom Group trading room, should the CPI peak and turn lower, this may signal to investors that the Fed can manage the inflation outlook better and become less hawkish in the back half of 2022, setting the floor for a second half rally consistent with other midterm election year trends. Because that tends to be what happened. We have a year-end rally in the back half of the year. Now, we all have seen the 10-year yield and rates move higher rather expeditiously. This chart right here tells us, and this goes back to 1984, the current leg of the 10-year yield rally has gained 157%. This has only been exceeded once since 1984. The 10-year yield has only gained that much in such a short period of time once since 1984. If we convert this occurrence into a percentile, the rally is in its 96th percentile, likely suggesting peaking of uptrend ahead of consolidation. Based on probability models, there is only a 3.4% chance it is not the topping level for the 10-year yield, based on the other 29 periods measured. More than likely, based on history, we're in the topping phase of the rise in the 10-year yield. I mean, there's only a 3.4% chance it's not, which is still a chance. You're saying I still have a chance? All right. Now, a couple disciplines I want to talk about here, and this is why also we buy the dip. We look at the 4 trend lines here. These are the actions of investors, when the market swooned back in March of 2020. Each trend line measures the actual return based on the actions the investors took. So this shaded line here, this is if you removed equity allocations on 3/11/2020. If you did, you would have locked in a 6% loss by the end of the year. If you reduced equity exposure on the same date, you still would have had a minor gain by the end of the year, 2%. If you rebalanced each quarter, the first quarter, the second quarter, the third quarter, and the fourth quarter, you would have had a nicer gain at 10%. But if you increased your equity allocation or your equity exposure, you had the greatest gain at 14.68%. That's why you buy the dip. And this is true of most any market correction and or bear market. I also wanted to look at rolling time, not just 1 year, but 5-year periods. So this is a good way of calculating the current market swoon and a way to kind of eliminate the fears and put us in the right frame of mind as an investor, thinking longer term. So I looked at rolling 5-year periods in the S&P 500 going all the way back to 1950 to find out how often an investor has experienced a negative return over a rolling 5-year period. It turns out not very often did you have a negative return over a 5-year period. Only 7% of the time over all of these rolling 5-year periods, which are 18,199 observations using daily data, did an investor experience a negative annualized 5-year return. The most common outcome was an annualized 15 to 20% return. Most of the time, you're going to get a double-digit return over a 5-year period, a rolling 5-year period. And keep in mind, folks, right, going back to 1950, that includes 11 recessions, multiple Fed tightening cycles, the dot-com bust, 9/11, and 7 different time periods when the CPI was above 5%. Stick with the market. Extend your time horizons. Be a dip buyer. Use the cash on the sidelines wisely, prudently, and continue to monitor those macro fundamentals. Thank you for joining me on this week's State of the Market. We'll see you next week.